Hey guys, and welcome back to another episode of Let's Discuss. Today I'm going to be talking a little bit about market volatility, specifically when it comes to dips in the market and how to approach that, and helping you guys decide when is the proper time to buy and potentially sell. So I just want to kind of cover that because the markets today have kind of seen a little bit of a plunge, so I'm sure people are a little bit concerned or a little bit weary. So I just kind of want to answer some of your questions that you may have. Feel free, if you have more, to drop them in the comments. I'd love to help. But I kind of talked a little bit about the potential for a market correction on my video from Monday. So if you haven't seen that already, check that out. And then, of course, guys, if you like the video and enjoy my content, please like and subscribe. And then I can also be followed on other social media platforms, on Instagram, Twitter, and TikTok. I can be followed at bpruitt_YT. And then I can also be liked on my Facebook page or followed. That can be searched under my name, Bryce Pruitt, or it's under the handle at bpruitt, capital YT. So I have a link to those in the description. So check that out if you haven't yet. So if you do follow me on Twitter, I do have my next Twitter poll up in regards to deciding the next stock I'll talk about in the next Thursday's video. So right now it's between Pepsi, Carnival Cruise Lines, and Amazon. So I gotta pick three very different companies for you guys to choose from. So if you're interested in that, check that out and vote in the poll. I started it today, so you have plenty of time to get that in. And then one last bit of information before we start the discussion is my raffle for the $25 Walmart gift card is still ongoing. I have not gotten as much interest this time around as I did the first time, so I am strongly considering extending the deadline to enter another week. Right now it's supposed to end next Wednesday, and the drawing is supposed to be next Thursday. But I would like to at least give people more opportunity to join if they are interested. And so yeah, just check out my social media pages for more details on how to enter. But again, the first step to doing so is to subscribe to the channel. So again, just check that out if you are interested. So with that being said, guys, let's discuss how to decide when to buy stocks. So guys, of course, just like with anything else in investing, there is not just one way to do something. There are many ways or philosophies on how to invest and how to specifically look at buying stocks. But I'm just going to kind of talk about some of the strategies I use and implement in my own portfolios. So the first one, and probably the biggest one on deciding how and when to invest in stocks, is just to set a recurring investment for your portfolios. So whether it be, every week, every 2 weeks, every month, every so often you have an automatic payment that just goes in your portfolio, and it is just invested in whatever way you have it set to. So this is just a really good way to just have steady cash flow, and whether the market's trending up or trending down, you just get a kind of mix of pricing, so you're kind of priced into whatever the market is at that time. I personally do recurring investments every 2 weeks. That's what personally works well for me. I know everybody's different and everybody works in different money amounts, so whatever you can do, I would strongly encourage you, especially if you're starting out, to just set a recurring investment, to just add so much money every so often. Just kind of get in the rhythm of things, kind of start a cycle on how to buy stocks, and just keep an eye on your investments. So, and then with that being said, one of the most important strategies that I follow, some people kind of disagree with this in different capacities, but I believe very strongly in dollar cost averaging. So that's just taking into account different prices to get that average of cost. So say you buy something and it goes up. Well, if you want to buy more, you're going to have to pay more. So you're going to pay what you paid before, and then buy it again, and then your average cost will go up. So that kind of just prices you into the market, either if it is going up or if it's going down. So it's a good way if you're, especially if you're down on a position and you're losing money, buy it at a lower price to lower your average cost. That way, if it does trend upward again, it's easier to climb that bar of your average cost to where you can get to your profits a little sooner if that upward trend does continue. So the second point I want to kind of make in this video is dips are good, crashes are not. So by what I mean by a dip is something kind of like what you've seen today. You know, I mean, the Dow being down 400 points, NASDAQ being down, not far behind it. Obviously, it's not something you want to see, you know, a lot of red, but it does present opportunities to buy your favorite stocks, if you have them, at a discount. So the market's going to be very volatile from day to day. I mean, you never know what the next day brings. So if you do see a red day, then I would strongly look at, you know, what's causing that, you know, what's leading to that movement. And if it's nothing too major, and if it's a company that you're particularly interested in and that you believe in, then by all means evaluate it and make a decision to purchase a little bit more at a discount. But on the flip side, crashes are not good. Crashes and a dip are a little bit ambiguous in their definition, but I generally regard as a crash as being a rapid decline in share price or index price in a short amount of time that kind of leads to panic selling, you know, over just everyone's very on edge and there's a lot of selling and it's not a buyer's market. So something like this is like what we saw with the financial crisis in 2008. In late 2007, the S&P 500 was around 1550. Shortly after that, it dropped quite dramatically to about 800 points, I think, at its low. And it did not recapture that high of around 1550 until early 2013, around March or so. So that, especially for people who were a little bit older or getting ready for retirement, that was a very scary time because, you know, they had those highs in 2007 and then did not see those again until 2013, assuming they kept everything they had. You know, a lot of people, when they have significant drops like that, have the urge to sell off. And depending on the circumstances, that may be a viable option, but generally history has shown that it is not, that if you just stay in, you will generally probably come out okay. But prolonged downturns like that are never good. But sure, you know, week, 2 week, even month-long corrections where the market maybe drops back about 10% or so, and then those can be okay. Those are good opportunities to create wealth. But like what we saw with the financial crisis 2008, even a year ago with what we saw with the COVID crash, although it was short-lived with the V-shaped recovery, is still something that is very scary and is very rare. I mean, we will probably never see anything like that again, so don't think that the last year is really anything to measure up to, because it's just nothing we've ever seen before. So for the next couple of points, I'm actually going to switch over to my computer to show you some of the things that I use on there. Okay, so yeah, wow. Like I said, very red day here on the markets as the S&P is down about 2.8%, Dow's about 2%, and the NASDAQ's really taking a beating, down about 3.8%. And we still have about 20 minutes until market close, so this might get a little bit worse before it gets better, but also I could see a little bit of buying going into the closing bell. So the first thing I wanted to kind of address today is something I mentioned on Monday, and that is the concept of using moving averages to evaluate stocks, particularly when it comes to a 50-day moving average and a 200-day moving average. There's two general terms people like to use on a basic level, which is the idea of a golden cross and a death cross. So a death cross is actually this example right here, where a 50-day moving average, or the shorter duration average, moves below the longer term average. So this purple line here is designated as the 50-day moving average of the stock, which is just an average share price over the previous 50 trading sessions. and then this is the 200-day, where that's the average of the previous 200-day trading sessions. So whenever the lower one moves below the higher one, then that is what's called a death cross, which generally signals a sell or a downward trend long term. And then the opposite is true here, which is what we see. And then that is called a golden cross, which is when that lower moving average, the 50-day, moves above the longer term moving average, which is the 200-day in this case. So when that happens, that shows a longer term upward trend, which you can see here also aligns pretty well with the share price, this being Bank of America. So here, this is their 1-year chart. So this is when the COVID crash happened. So very much a sell signal occurred, and then throughout the middle part of 2020, still remained that way. But then here in the fall, we saw finally the 50-day moving average move above the 200-day and gave way to a prolonged upward trend that we're still seeing as of today. So you can even apply that not to just only individual stocks and companies, but also with indexes as well. This is the SPY ETF, which tracks the entire S&P 500. So again, when the COVID crash occurred, we can see the dip here that signaled the death cross, and then it wasn't again until the summer, particularly in July, that it crossed back over, which showed a buy signal, and obviously that is carried through to now, steadily above this 200-day moving average. So a very, very basic technical readout, but one that many investors look at to kind of help them make their decisions. And then the last point I want to make today is actually something I created myself using Google Sheets and Google Finance. I created this chart to track my investments. So as you can see here, here's all my holdings. Here's their current trading price, which is connected using Google Finance, so it automatically updates itself. Here is the change in percent. Here's the change in dollar amount. And as we can see, it's a very red day, so almost all of my holdings are very, very down. And then here's an interesting thing that I created, which is my daily rating system. So basically it looks at every stock and see how it performs that day, and based off that performance in tandem with if I'm making or losing money on that holding and how it's trended over the last 15 days to either recommend a hold or a buy. So here I created this on my own formula. So if the stock is trading in the day down 1.25% and is also down 2.5% or more over the last 15 days, then it will recommend a buy. And then regardless of its recent performance, if I'm down on that position, which is this part, like it says a loss, then it will recommend a buy. So that's just something I created myself, strictly on my own. So that is something for you guys to consider doing as well. It's very easy to use Google Sheets to create Google Finance once you get the hang of it. So I basically just have all this data at my fingertips. I have their market cap, I have their PE ratio, which is price to earnings. So I have all this at my fingertips, color coded, just to help me kind of automatically see it and be able to visualize it. So if you guys would like to know more on how to create something like this, I would definitely be open to creating a tutorial video, but again, that would just be subject to you guys. So yep, that was a little bit about some strategies I use to help me decide when to buy my stocks. So if you guys did enjoy the video, go ahead and drop a like, and if you enjoy my content, subscribe to the channel. I just want to kind of put some of your guys' concerns at ease. I know it being a very, very red day on the market can be a little intimidating, but my general recommendation is just stay the course. Try not to do anything too rash. History has shown that people who stay in the market long term generally fare pretty well, and I think everything will work itself out. So I will catch you guys in the next video.